You're watching Stock Watch. I'm Zinati Kuma, and joining me to unpack your stock-related questions today are Ricus Reeders from PSG Hole-in-One Ruimsig and Zwelakhe Mnguni from Benguela Fund Managers. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, gents. Lots of central bank decisions were made. We had the Fed last night, of course, only digesting that today. And then we had the South African Reserve Bank, and we also had the Bank of England. Zwelakhe, starting off with you, was there maybe a thread as to why these central banks decided to keep interest rates unchanged?
Yeah, phew. I think I could understand the US. I think this trade war or tariffs war is likely to be inflationary in their numbers to the extent that trade contributes to GDP. I don't understand the decision in terms of South Africa and the UK. I mean, the UK has been struggling. I think this would have been an opportunity for them to kind of give their economy a boost. I think on the SA side, I see it even worse, a single mandate of inflation targeting. Inflation is closest to the low end of the band of 3.2 versus 3, within a 3 to 6 band. And they didn't take their advantage of today's rate cut. I mean, I would have expected that Mr. Lesecha would have cut this time, but it was quite disappointing in my view. There was no reason for him not to cut. I think the economy, yes, the economy is kind of showing a recovery momentum. That momentum actually needs a boost against the backdrop of a VAT hike. So, yeah, I think it's a lost opportunity for UK and SA. And I think it's understandable for US.
It's quite interesting because Kopano from Reuters, after the MPC decision, when it was the Q&A session, actually asked if the governor is maybe not, if the global risks are not maybe putting on more weight in terms of the decision making of the Reserve Bank, instead of them actually zooming into the local economy and actually, realizing that inflation is still on the lower end of the target band, and that actually they have more room, particularly because they started increasing interest rates earlier on. Ricus, do you think that it's valid that they kept rates unchanged, or maybe there was really room for them to cut rates?
Yeah, I think it's it's basically the battle between protecting the value of the rand and boosting the local economy by making money cheaper. And so far, they're really just concentrating on attracting foreign capital and on keeping the rand where it is. But yeah, I agree. It's a bit nonsensical if your mandate, as Zwelakhe has said, is to look at inflation, and we are far below the midpoint of their range. It's just disappointing as far as I'm concerned.
Yeah, because I'm also thinking if they don't cut now, then it's going to get even more difficult. So,
yeah, I wanted to add that if you look at the inflation, I mean, the important component of inflation correlates very well with the rand oil price. With a lag of about 6 to 12 months. And if you look at that, over a year, we are down 21% on that rand oil price. If you take the fact that oil peaked at about 83 and you had the rand also strengthening against the dollar, there was no reason. I think that's why I say it was quite a surprise and a disappointment.
No, I completely hear you on that. But I mean, the rand really has been on a good momentum, also being supported by the gold price. So I wonder if it actually would have been much of a weakening if they had cut interest rates. Well, talking about interest rates, let's go into banking. We have questions on FirstRand Investec, and Nedbank. Let's start off with First Rand. Could you please provide an analysis on First Rand, including buying levels? Well, I think Ricus gone. Okay, Zwelakhe, First Rand. At this point, I know that there has been a cloud hanging over it because of the kind of regulatory situation case that they have in the UK in terms of the car finance business. But I mean, yeah, would there be a buying opportunity for First Rand looking at the green shoots that we are seeing in the economy, where they're starting to feel maybe less pressure on credit impairments?
Yeah, I would think that if one looks out more long term, I mean, so 3 to 5 years out, I think it's not a bad level to be buying First Rand at these levels. But if you're a short term investor, I mean, you're looking in the next 12 months, there could be sideways movement. But from a performance of their businesses, I mean, it looks like they've maintained their ROE, they've grown earnings 10%, they've grown NAV just under 10%. And it's a well-run business. It's proven in many areas. So I don't think you'd go wrong. I mean, it trades at a high price to book multiple compared to peers, but I think it's deserved. I mean, you look at the peers, they're probably sitting at around 15 to 16% ROE, and they are sitting at about 21%, and they've maintained that lead. I think they're only second to Capitec.
Well, Ricus, let me give you Nedbank, your opinion of Nedbank as a buy. And lots of people had actually, I'm just trying to think, I actually think Nedbank was kind of lagging in the last week or so. Maybe a buying opportunity, Ricus?
Yeah, I mean, the share price itself was doing very well prior to their earnings release, and I think the market didn't quite like it, and we had a little bit of a pullback on that. So price momentum wise, it's not exciting. I think they are lagging as far as innovation is concerned in comparison with the other major big banks. So they're not expensive at all. I mean, historic price earnings of about 7, div yield of about 6. So it's cheap. So maybe a trading buy at these lower levels, but for longer term growth, I'd rather concentrate on something like First Bank. As soon as they get their car financing business in the UK, you know, when that problem disappears, I think that court decision or court hearing is somewhere early in April. If we can get rid of that, I'd rather be in something like First Rand or Standard Bank rather than Nedbank.
Ricus, just sticking with you in terms of First Rand, I do understand that this car finance situation is still ongoing, but they have set aside provisions for worst case scenario. Do you think that if things don't work out for them, there could still be more pressure that they're feeling, or maybe that it's completely out of the system because investors know about it?
They know that there's a court case.
Yeah.
That's the one thing we know. We know that they've provided. That's the second thing we know. The third thing is the uncertainty of whether they've provided enough or not.
Okay.
And fourthly, you know, the initial case was unexpected, and you can't really discount for the unexpected. So I'd rather have more certainty about what's happening there and get that out of the way. And then one can take a look at the business and say, okay, you know, now we're dealing with normal company risk rather than an external risk in the form of some or other liability imposed by an outside force.
Okay. Well, let's take a look at Investec. Today they came out with a pre-close trading statement. I think it was for 11 months, and that share had seen pressure. I think in terms of the bottom line, they said that it could either decline by as much as 8% or rise by as much as 1%. And looking at the the difference in the geographies, the SA and the UK, it seemed that the UK was a bit shaky there, Zwelakhe. Yeah, investors not liking that, down on the day by 4%. Yeah, what's the narrative here, Zwelakhe?
Yeah, look, I was a bit surprised by the UK. I mean, it had been building quite a nice momentum on the banking side.
Yeah.
And it seems that the momentum has kind of fallen over now, and they need to increase efforts. I think the SA side was not also amazing, but I think they did get the benefit of lower impairment costs. So if I look at it, I mean, I think the shiny star was the wealth business. I think it did much better than the expectations. But ultimately, this is a bank, and the ROEs are probably barely meeting the cost of capital. I think it might create a buying opportunity if it continues to decline. Okay. It might create a buying opportunity.
Yeah, quite interesting, because I do think that the ROE was on the lower end of that target. Ricus, your thoughts on Investec, because I feel like it's seen as one that is maybe more defensive because of its client base compared to the big 4 or 5 banks that are mostly SA focused. Your thoughts on this kind of disappointing result?
Yeah, it's funny. Investec has this propensity of doing very well, and then there's a quarter or a semester of things going wrong. This is part of the history. So I was interested in for the first time in a very long time, about a year ago, but you get this kind of disappointment, and really, one would like some consistency. I mean, they've been reimagining and reforming themselves for a very long time now. At this stage of the game, you don't need this kind of uncertainty. Yeah. So I don't really, because if I want to go into an international type of tied bank, do I really want to go into Investec? And I don't think so. I think there are better opportunities elsewhere.
Yeah, all right. The question that is coming up is on rotation out of US stocks. Record rotations of fund managers out of US stocks in history. Time to do the same, or time to buy? Of course, we have seen the US stocks under a lot of pressure, and actually some people opting to go to China, for example, Tencent. So just looking at this, Zwelakhe, do you follow the smart money and leave, or do you go the opposite and buy?
I'd probably remain invested in the US, but select based on quality and valuation, and emphasize valuation. I mean, there are areas of the US market that haven't seen extended or extreme valuations like what we saw in the AI sectors or AI-related sectors. But I'd probably still remain in the US. I think if I look at the risk of being in other areas where the US is actually charging forward to those countries in terms of making the cost of trade higher, I'd probably feel a little secure in the US, but there are opportunities everywhere. I mean, Europe has seen a big improvement. Asia has seen a bit of an improvement. Those areas are still relatively cheap, but I wouldn't exit the US in totality. I'd probably hold a equal weight if I could.
It's quite interesting, because I think when we talk about US stocks and rotation, we're usually thinking in our minds tech. So rotating from US tech to maybe Chinese tech. But should we look at it from this particular lens, Ricus, or should we broaden our lens?
Yeah, I think what we are seeing is not necessarily, well, it is a rotation out of the US, but it's also a normalization of of where you're going to put your money.
Yeah.
You know, at the start of the year, the US stock was about 2/3 of the All Country World Index. So up until January, there was nowhere else that people were putting the money, only in the US. So what we're seeing is just the reverse of that, and into geographies. Europe in itself is not exceptional, except that people were underinvested in, as you know, in companies which were at a real discount compared to their American counterparts. So it's just people spreading the risk over geographies, and that's why we're seeing the inflow specifically into Europe. China is something else. I think last week, with their first really concrete plan to boost consumer spend in China, that's looking quite interesting from a trading point of view. I would still not invest in China because things can change so quickly as a result of political interference.
All right. Well, let us compare Shoprite and Boxer. The viewer says, I realized Shoprite dropped 15% from November 2024 to date. I like Shoprite, more specifically their growth strategy, constant market share gains and management team. Does this present a buy opportunity for long-term, this dip? Or should I look at Boxer, which I'm a bit skeptical about because I don't have enough financial data to look at? Zwelakhe.
Yeah, I'd probably go with Shoprite. I mean, they're more or less trading at about 22, 23 times. I think Boxer is about 23 times earnings. I think if I look at what would be attractive for me in Shoprite over Boxer. So Boxer has got a narrow market focus, which they are executing very, very well.
Yeah.
But you look on Shoprite, they are moving into the broadening their offering, and they're covering more LSMs within the economy. And the benefit of that is that they've been able to beat other players. I mean, Spar, Woolworths, they've all lost some market share to Shoprite. And that's primarily because they're executing well and they are connected with the customer needs in a way compared to Boxer. So Boxer is a still growth story. Shoprite is probably a broadening of a offering plus a bit of stock growth.
All right. Okay. Zwelakhe says Shoprite over Boxer. Ricus, your take?
Yeah, Boxer is interesting, but I'm far more comfortable with Shoprite, as the viewer said. I really don't have enough financial data and an historical feel for Boxer. If you take a look at Shoprite, that its current historic PE, it's well below the sort of 5-year lease squares, which is sitting at about a 26 PE. It's historically at about a 21 at the moment. So the price is moving sideways. So I think it's and it will do that till such time as earnings catch up with what is still a reasonably hefty price earnings. But I don't buy things which are below the 200-day moving average. So I won't be buying right now. Just wait for price momentum to start turning up again.
All right. Well, people were buying into Pepkor yesterday. So this question was sent yesterday on a Pepkor. Any specific reason for the 7% rise? Of course, it rose yesterday. It's given up a little bit today, ended off the session down 1.54%. But Zwelakhe, I mean, from just what I saw yesterday, we had the inflation print coming out and retail sales that ticked up. So was it not that? Was that not responsible for the rise in Pepkor yesterday?
I thought it was, and probably if you look at what came out today, there was probably a bit of speculation around whether the sub would unshackle the shares that are held against the stand of dealings in the past. But it doesn't look like we are there yet. So I think that could have influenced the slight pullback we've seen today. But I think from a retail perspective, they're well positioned in the lower LSMs, and I think that could be beneficial if things get tight in the economy. But the momentum seems to be more positive in the economy, so I think they will also participate in that upswing.
It's quite interesting because I think at the thick of it, when everything was coming down on the consumer, people thought that Pepkor would actually benefit because it is the value retailer, and people were trading down. But I think there was a period where they also just were struggling. But Ricus, would you say that we have seen a sustained turnaround where that stock has looked attractive and there has been consumer activity coming back into the company?
Yeah, talking my book here because Pepkor is my clothing retailer of choice in my portfolios. The lower end of the market is probably somewhat defensive, but what interests me is what they're doing on the finance side of things, which is growing very well. And yesterday's price move, I think it's the Reserve Bank decision not to unlock trading in the shares that are being held offshore. Obviously, that limits the prospect of those shares coming to market.
Okay.
But in general, as I've said, Pepkor, if you want to be in clothing retail, I think that's the one I would go for.
All right. Well, gents, let us get to your stock picks for the day. Zwelakhe, what are you hanging your hat on?
The stocks pick games and Mark's game. So I'm going with Alphabet, the parent to Google. I think the market has put the stock under quite a lot of pressure relative to the other mega stocks. It's trading at about 22 times. But the threat has been two ways, that artificial intelligence would threaten Google search. Secondly, that there could be a forced breakup of the business. I think those are probably in the price. I think the business has got many levers where it's invested capital over the years, and it can basically unlock some or monetize some of those. And I think Google search should be good to defend itself against the AI search. So I feel that it's probably a more defensive, more on the valuation side than anything else.
All right, Ricus, let's end off the show with you. Your stock pick for today.
Yeah, going pretty defensive, and I think there's also more of a trading opportunity because I'm as uncertain as the market is about exactly where world markets should be as a result of the trade war going on. It's JP Morgan. It's down about 15% from its highs at the start of the year, so that's a good pullback. It's right on its long-term average. I think it's probably the best around US bank at least, and it's sitting on a 12 price earnings, which is not expensive, and it's one of those stocks that I really favor, as a consistent dividend grower, and it's done that for the past 15-20 years. So again, that's just testament to the fact that they know what they're doing.
All right. Well, thank you so much for your time and for your insights today, gents. Really appreciate it. And please do have a lovely long weekend. That is all for tonight's Stock Watch. Thanks to our guests, Ricus Reeders from PSG Hole-in-One Ruimsig and Zwelakhe Mnguni from Benguela Global Fund Managers. Up next, the close. Stay watching.
Thank you.